Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we place some focus on an often overlooked area of the investment market. We speak today, of course, about conservative investing and the conservative investor. Risk-averse individuals, with the main objective of preserving capital, are often quite content to sacrifice usually higher returns in return for the potentially avoiding some losses which may occur with investing. So let's get straight into it in terms of the conservative investor and their risk profile. In terms of conservative investing, return requirements are often focused on income generation and capital preservation. Accordingly, the risk profile of the conservative investor and conservative investment options tends to be on the lower end of the risk spectrum. The investing horizon can be variable, with some investors having higher liquidity needs, therefore investing for the short term. And on the other hand, some investors may prefer to invest for a longer time period with lower liquidity needs. So what's available to these sorts of investors? Well, there's a wide array of investment options, but we can break them out into some of the more major alternatives. And those include income funds or money market oriented funds, repurchase investments, investment-grade bonds, and dividend-yielding equities. As you would note, income funds and repurchase agreements tend to be on the lower end of the risk spectrum, and at the opposite end, there are dividend-yielding equities. And traditionally, dividend-yielding equities and equities in general have not been thought of as a conservative investment alternative. Let's take a closer look at each of these investment options. And in the case of income-oriented or money market mutual funds, again, it appeals to those investors who have a much shorter time horizon, usually less than 1 year. And in fact, most money market funds or income-oriented funds offer investors daily access to their investments. In terms of expected returns, it's above what the traditional savings accounts at major commercial banks offer, with most income or money market funds offering in the range of 0.8 to 1.75%, and this is across both TT dollar and US dollar investing options. The risk level, again, is on the lower end of the spectrum, and that's because income-oriented mutual funds often invest in a diversified basket of relatively low volatility investment instruments. And as we mentioned, the liquidity needs suit investors with higher liquidity requirements. Repurchase agreements are similar to the traditionally understood fixed deposits and can vary from as little as 3 months to out to 3 years in terms of time horizon. Expected returns on a repurchase agreement or a repo can vary from 1.5 to 2.75%, depending on several factors, including the amount of time that you invest for and the collateral that is being used as security for your investment. And that's an important feature of a repurchase agreement, which is different from a regular fixed deposit, in that there's specific investment collateral, usually bonds or equities, that is put up as an added measure of security for your investment. The risk level, again, because of this, would be on the lower end, and liquidity tends to be higher for those persons investing at a shorter time period. Investment-grade bonds and bonds in general are thought of as relatively safe investments. However, there are no two bonds that are alike in terms of risk and reward. Broadly, as defined by credit ratings, bonds can be classified into two categories when it comes to risk: investment-grade bonds and non-investment-grade bonds, or high-yield bonds. The conservative investor tends to opt for investment-grade bonds, which have a higher credit quality, meaning that there's a much higher likelihood of ability for the issuer to repay, and of course a lower possibility of default or any other credit-related matters. In terms of time horizon, bonds tend to be a medium-term investment with around 3 to 5 years on average, with expected returns based on the quality of the bond you're investing in being in the range at the moment of 3.5% to 5%. The risk level can be variable. The higher you go in terms of credit quality, the lower your return and the lower your risk, and vice versa. And liquidity can be variable as well. And investment-grade bonds are available both in TT dollar and US dollar options. And finally, one of the lesser-known strategies for the conservative investor, but one that's growing in popularity, is the dividend-yielding equity strategy. And this really relates to investors who are able to take some measure of equity risk in return for higher returns, but would like to have some stability in the price of their equity and certainty or relative certainty of income received from this investment in the form of dividends. So for a strategy such as investing in a portfolio or 1 or 2 dividend yielding stocks, you would look, some of the characteristics that you would look for would include a relatively low dividend payout ratio, relative stability in earnings, and of course stability in the price, which makes it easier for you to get in and get out of your investment should the need arise where you need to generate some liquidity. So overall, as we can see, there are several options that are available to the conservative investor and those focusing on conservative investing. And as mentioned, the risk and return is pretty linear, which is what most rational investors would expect, with income funds on the lower end at 0.8 to 1.75%, and on the higher end for dividend yielding equities varying from 3 to 5.5%. So lots of investment options available for the conservative investor. To find out more about which conservative investment may be more suitable for your portfolio, give us a call at 226-8773 or 2Bourse. Visit our website at bourseinvestment.com or email us at invest@boursefinancial.com. Have yourselves a great investing week. This has been the Bourse Report.